The information in this episode is current as of the date recorded and is not intended as financial, tax, or legal advice. You should consult your tax, financial, and or legal advisors before implementing any transactions and or strategies concerning your finances. And with that, let's get to this week's episode.
Hi everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of October 7th. If you're new here, welcome and thanks for joining us. I hope you find this information helpful. If you're a regular, I do want to remind you that you can always put comments and feedback or questions in the comments under the video, and I'll do my best to get around to that. If there's a topic you'd like us to address or explain, you can throw that in the comments and we'll make sure we include it in the next episode. With that said, my goal is always to use my background in economics to help you better understand the markets and to understand the financial landscape. So with that said, let's hit the books and get up to speed. Of course, the big news from last week was the unemployment report. The Bureau of Labor Statistics released their monthly unemployment report for the month of September, and everyone was shocked by the 254,000 jobs that were added in the month of September. And in fact, this exceeded the expectations by more than 100,000 jobs. Now, of course, revisions are common and normal, and we will most likely see revisions to this number over the next few months. But along with this massive increase in jobs, we also saw an upward revision to the July and August job numbers by about 72,000 between the 2 months. The reason the revisions are so important is because the revisions include additional data that's received after the initial report, and so at least in theory, the revisions are more accurate and more relevant than the original number that's released. So the unemployment rate in this report was 4.1%. This is lower than the rates in July and August, and significantly lower than the 4.4% that the Federal Reserve is projecting us to finish 2024 at. This national unemployment rate is important, but it's also important that we dig into the data a little bit deeper, because that rate doesn't necessarily apply to every group equally. Some groups do better, some groups do worse, and it's important to understand which groups are being affected disproportionately. And in fact, in this report, some of the good news was that male workers, Black and Hispanic workers, and workers with less than a high school diploma actually saw a greater drop in their unemployment rate than the average. The reason this is important and beneficial is because these groups have also seen significant increases in their unemployment rate in recent months. And so this gave us an idea that some of those trends may be reversing, and these groups may actually be improving their economic situation. Before the unemployment report, we also saw the unemployment insurance program reports. The nice thing about these insurance program reports is that they're released weekly instead of monthly. So we're able to get a more up-to-speed or more current picture each week on the unemployment insurance program. For those of you that may not be familiar with this program, if you lose your job for a reason that is beyond your control, say you were laid off, you're able to file a claim against unemployment insurance and receive an unemployment check. This is traditionally how we think of unemployment, but one of the drawbacks is that this program only applies to those folks who lost their job involuntarily. So it's only a subset of the overall unemployed population. Now, what are these reports telling us? Well, these reports have shown us that over the last 2 months, the unemployment insurance program has either been stagnant or declining. In terms of the initial claims and in terms of the continuing claims, we've seen essentially a stagnant, if maybe slight decline over the last 2 months. And we see both of these indexes operating at about the level that we saw in 2023. Coming out of this unemployment report, we also saw information on the unemployment diffusion index. This index helps to give us an idea of how widespread the job gains or job losses may be. And in fact, it keeps track of what proportion of firms in the economy are adding or no change in jobs versus what proportion might be cutting or reducing jobs. So the value for this month was 58%, and this is higher than the last 2 months, meaning that not only are we gaining jobs, but we're also gaining a diversity and a breadth of where those jobs are coming from. The broader the job gains are spread, the more broadly beneficial and sustainable those job gains actually are. Last of all, we saw the earnings report, and beneficially, the earnings report showed a 4% increase year over year for average earnings. Now, that number by itself isn't enough to determine if that's a good or a bad result, but when we compare that 4% gain in earnings to the 2.5% inflation that we've had recently, it demonstrates the fact that the earnings growth is increasing more quickly than the inflation or the price growth. When earnings exceed price growth, what we see is an increase in what we call real earnings, or people's real ability to actually buy more things and improve their quality of life. So hopefully, we'll continue to monitor this, but hopefully this trend continues, and in the future, we're able to see more growth in earnings with a calm and not growing inflation level. Last of all, the stock indexes last week all showed a little bit of growth. There was some up and there was some down, but they all ended the week in positive territory. More importantly, we're seeing the diffusion or the dispersion in the S&P 500 gains increasing to a very healthy level. So about 69% of the S&P 500 firms, their current price is exceeding the 50-day moving average, meaning that they're in a better place today than they have been over the average of the last 50 days. This is something that's very important, similar to the unemployment diffusion. When the gains are diffused in the S&P 500 market, it shows that it's more than just one or two businesses that are benefiting, but the broader market is all enjoying gains, which tends to be more stable and more sustainable than small bursts for a small number of companies. So we're also monitoring the price to earnings ratios within the S&P 500 and the broader markets. The interesting thing is that right now, the trailing 12-month or the backwards looking price to earnings ratio is significantly higher than normal. This higher than normal price demonstrates that we may be overvaluing a majority of these stocks. But if we look to the forward price to earnings ratio, meaning looking at forward earnings, what we think these companies will do in the future, that price to earnings ratio is well within the normal range. So the questions become, are the stocks overpriced currently? Are the future earnings going to actually match our expectations and our predictions? And where will these price to earnings ratios move over the next few months or next few quarters? We'll continue to watch this, and if there is significant change, we will make sure we bring that to you in our weekly market update. One of the areas that we're watching this week is the 10-year Treasury yield. This yield had dropped as low as 3.6% in the last few weeks and has now increased back to a level above 4%. And the question is, why? The 10-year Treasury yield demonstrates or represents the general sentiment in the fixed income or bond market, as well as some very important general sentiments about the economy as a whole. The fact that this yield is rising demonstrates that either there's an increased supply or a reduced demand for these 10-year treasuries. So what could be causing this? It's potentially an optimism about the future growth of the economy. So investors are looking for a greater return than fixed income or bonds offer, and maybe migrating or maybe moving from the fixed income to the equities market. It could also represent investor concerns about inflation. When inflation increases, investors tend to demand higher yields to compensate for that lost purchasing power. With the big 50 basis point cut the Federal Reserve implemented at their last meeting, it's possible there's concern that there will be a resurgence in the inflation level. Last of all, It could be that the big cuts, the big reductions in the federal funds rate that have been expected and have been priced into the market are now being unwound. Part of the reason that these markets are interesting and relevant to monitor is because they tend to attempt to anticipate what the Fed and what the economy is going to do in the future. You can think of it as a sort of prediction. The markets, up to this point, prior to this jobs report, had been expecting significantly more interest rate cuts than the economists had been projecting for the Federal Reserve in November and December. One possible explanation for these yields increasing is that now the markets, seeing this strong jobs report, are starting to adjust and realign their expectations. And it's possible that they are now expecting less cuts, smaller cuts, or no cuts at all based on the strength and health of the U.S. economy. It's important to mention that a strong economy doesn't mean that everyone is benefiting equally. And unfortunately, what we've seen in the last few years is that our strong economy has benefited some and has failed to benefit others. But what these investors could possibly be considering is that if the economy is strong enough that the Federal Reserve doesn't need to cut interest rates as dramatically as was expected, then there needs to be a realignment of where their investments and where their expectations are. And in fact, this plays into a big question that some of you may have had. Following an incredibly positive jobs report, why did we see the market fall pretty dramatically, a full percentage point in most cases, on Monday? Shouldn't the markets be excited about a growing and healthier economy? And the answer is yes, they should be. And in fact, on Tuesday, we saw a lot of those falls, a lot of those losses on Monday wiped away or recovered. So it's important to remember that sometimes the market is falling because of bad news, but it's also possible that on some days the market may fall because good news causes investors to change their expectations, realign their priorities in their investments, and there's a slight correction in them doing so. With the expectation of the Federal Reserve cuts decreasing to smaller cuts or slower cuts throughout this process, it's quite possible that maybe Monday's activities were centered on readjusting and realigning to that future expectation. Now, of course, markets move for all kinds of different reasons. So we can't say definitively why the market may have gone up or gone down. But changes in expectations with the Federal Reserve in regards to inflation can definitely influence investors to shift their priorities. So what's happening in the rest of the week? Well, some very important information is being released. The Consumer Price Index and the Producer Price Index are both being released a little later this week. The expectation is the Consumer Price Index will continue to fall from 2.5% to possibly 2.3%, demonstrating that our fight with inflation continues, but is still trending and moving in the right direction. Now, in addition to these inflation reports, we're also going to see earning reports coming from the end of the third quarter. Now, of course, at the beginning of earnings season, we tend to see financial reports, and they tend to dominate the conversation. In fact, JP Morgan Chase and Wells Fargo are both reporting their earnings this week. Bank of America and Citigroup are reporting their earnings next week. Now, this is important for a couple reasons. The first is that these four institutions are four of the largest financial institutions in the entire global economy. But it's also important because interest rate cuts tend to have a very direct and very meaningful impact on the financial sector, sometimes more so, at least more quickly, than the broader economy. So the big question is, how are these financial institutions performing in the third quarter, and how are they expecting to perform moving forwards? We can't finish up the weekly update for this week without mentioning Hurricane Milton. The hurricane is currently headed towards Florida and looks as though it will be extremely destructive as it moves through the state. Florida happens to be the fourth largest economy in the United States, and if they were their own country, they would be the 15th largest economy in the world. The effect that hurricanes have on the state of Florida reaches far beyond the individuals and the businesses within that state. As our thoughts go out to all the folks that are evacuating and who will ultimately be affected by this hurricane, it's also important for us in an economic and market-based update to keep in mind that there could be significant economic repercussions beyond just construction, beyond just damage. Florida happens to have a huge role to play in global agriculture, global medical work, as well as medical research, global trade, and global construction and housing markets. There's an inevitable impact on the insurance industry as well. And as the situation unfolds, we will do our absolute best to be respectful of the individuals affected by this hurricane, but to keep you up to date on how this hurricane and how the damage in Florida is affecting their economy and their ability to live and do business. Looking ahead, a lot of our focus in the future will be on third quarter earnings reports, including 50 companies reporting their earnings next week, 125 reporting the following week, 175 companies reporting the last week in October, and another 60 companies reporting their third quarter earnings in the first week of November. Over the next few weeks, as these earnings reports are published, it'll give us a better understanding of how the economy performed at the firm level over the last 3 months, as well as what the expectations are for the rest of the year and looking into 2025. It's important for me to remind everyone and keep our focus on the fact that the stock market, although it responds to macroeconomic changes as well as emotional or psychological behavioral changes, the stock market is primarily driven by earnings, both the reported earnings and the expected future earnings of the companies within the market. So as these earnings reports are released, it'll give us a lot more clarity and a much better picture of what the stock markets, as well as what the larger economy will be doing in the near future. As we watch these reports, we'll make sure to bring any interesting, any important, and any surprising information to you in these weekly market updates. Next week will also be a big week for housing. As the National Association of Home Builders releases their housing market index, we will get a much better picture of what the supply of housing looks like in the United States. Of course, right now we're facing a current shortage of housing, some estimates as much as 4 million housing units shortage. Understanding the Home Builders Index, the building permits, and the home building starts can help us get a better understanding of how the housing market, at least on the supply side, is responding to current economic conditions. Of course, we'll also see the mortgage applications information that's released every week, and we'll make sure that we update you on the rate of mortgages, the rate of mortgage applications, and the rate of refinancing on the demand side for housing as well. Lastly, it's important to mention the conflicts in the Middle East. These conflicts have already affected oil markets as well as energy markets in the United States. As we move forward and as these conflicts unfold, we will do our best to focus on the financial and economic impact of these conflicts. But as with the hurricanes, it's important to take a moment to recognize the fact that the economy is driven by people and businesses. And when we report on these catastrophic and destructive actions and events, that we are both acknowledging the economic impact as well as the human impact. We'll do our best to monitor these events and bring you the economic and financial information that you need to both understand the event and the implications of these events. That's it for this week's update. As always, we'll continue to watch the markets and the economic reports and bring you the information you need to stay up to speed. Don't forget to like and subscribe if you found this video helpful. And also, don't forget to comment any questions or any concerns that you may have. Again, if you're interested in a certain area or a certain topic, make sure to mention that and share it with us, and I'll do my best to include it in next week's update. With that said, thank you for joining us, and have a great week.